Welcome, everyone, to an SS&C Intralinks market update.
Great to be here.
Today, we are taking a deep dive into the SS&C Intralinks 2025 Global Private Capital Fundraising Report.
It's a really comprehensive look at what's happening out there.
Absolutely. And our mission, really, is to unpack 5 critical takeaways from this report. We want to distill these complex market trends into clear, actionable insights just for you.
Yeah, makes sense of the noise.
Exactly. Because this report, it paints a vivid picture. It shows a private capital landscape that's, well, challenging, yes, but also rapidly evolving. It's being profoundly shaped by recent monetary policy and, significant economic shifts.
That's right. It's definitely a market in flux. And understanding these fundamental shifts is, I think, absolutely crucial right now.
Couldn't agree more.
We'll explore how these changes are impacting, well, everything from who actually gets the capital to how it's eventually deployed.
Okay, let's jump right in then. To kick us off, let's talk about a trend that maybe isn't a huge surprise on the surface, but the sheer scale of the numbers is still quite striking. Takeaway number 1, the big freeze. Why central bank caution halted private capital fundraising? We're talking about a significant, sustained downturn here.
Indeed. Global fundraising activity has definitely continued its downward momentum. And the figures, they paint a pretty stark picture.
How stark are we talking?
Well, in 2024, we saw closed fund volumes decline by a staggering 45.1% year over year.
Wow, 45%.
Yeah. To put that into perspective, that's almost half the number of funds closing compared to the year before.
Yeah.
And the capital raise, that was also down by 18% year over year.
Okay.
So this marks yet another year of declines. And what's particularly notable is that activity levels are now even lower than what we saw before the pandemic hit.
Lower than pre-pandemic. That's saying something. A 45% drop in closed funds. That's a harsh reality.
Yeah.
So let's unpack this. What's genuinely driving this kind of deceleration? Is it purely a reaction to the interest rates we've seen, or are there maybe deeper, more systemic issues shaping this?
It's primarily driven by the caution of central bankers. Their focus on taming inflation meant monetary policy lingered at the highest levels we've seen this decade,
Right.
particularly in the U.S., where rates peaked around 5.3%.
Okay.
And this environment, it naturally escalated borrowing costs for companies, which in turn weighed heavily on valuations right across the board.
Makes sense.
So when assets are valued lower and borrowing is more expensive, it just significantly decelerates deal-making opportunities. Makes it much harder to both find attractive investments and, crucially, raise new capital.
Right. And what this means for you, our listener, whether you're a fund manager trying to raise capital or maybe an investor looking for new opportunities, is that firms, especially those newer emerging firms trying to establish themselves, they faced enormous hurdles just to successfully close their funds. The direct result, much longer fundraising timelines. It sounds like trying to swim upstream through treacle.
That's a good way to put it, exactly. And this challenging environment, it naturally leads us to our next major trend, because when capital is this tight, the critical question becomes, well, who actually is securing those funds? We're seeing a definite shift.
And this next point, takeaway 2, is truly fascinating. Safety first. Why LPs are betting only on the big guns and consolidating capital. It sounds like when money gets scarce, investors tend to circle the wagons.
That's precisely what we're witnessing. A very clear and deliberate shift in limited partner, or LP, preferences. So LPs, those are the institutional investors putting money into these private funds. They're prioritizing reputation, deep experience, and crucially, proven track records above almost everything else right now.
Gotcha. Playing it safe.
Exactly. For instance, the share of first-time fundraising volumes. It fell from nearly 18% down to just over 16% in 2024.
Okay. A noticeable drop.
And if you look at the 50 largest funds raised last year, they were almost exclusively managed by established, experienced firms. Really only one notable exception. The government of Oman's first-time $5.2 billion buyout fund. Otherwise, it was the incumbent.
That's a huge shift in investor behavior, focusing on the known quantities, and it seems like it's had a direct impact on those fundraising timelines we mentioned.
Absolutely.
The report indicates that the median time to close a fund actually rose from just under 15 months to over 18 months in 2024.
That's right, 18.4 months.
18.4. That's nearly 6 months longer than the historical 12-month median we're used to seeing. And it remains elevated, right? Still at 18.3 months year to date. That's a real pressure cooker for fund managers, isn't it?
It absolutely is. This prolonged timeline, it has very tangible consequences. It means fund managers might have less time, ironically, to efficiently deploy the capital they do manage to raise.
Right, because the clock is ticking.
Exactly. This can potentially lead to maybe rushed investment decisions just to meet deployment deadlines, or perhaps a less strategic, more reactive approach to investing than they'd like.
So this flight to experience, this caution, it's also led to greater capital consolidation.
Yeah.
Fewer funds closing, but the ones that do are much, much larger.
The data really bears that out. Since 2020, the share of funds exceeding $1 billion has steadily risen. It went from just over 5% to more than 9% of total fund volumes in 2024.
Wow,
And year to date in 2025, that share is already up to 12.5%.
12.5%.
Yeah. So, to put it plainly, median fund sizes across all fund types have never been larger. It signals this clear trend towards consolidation among the established players, the big getting bigger.
Okay. Now, amidst all this downturn and consolidation, there's apparently one area that's really bucking the trend, almost thriving. That brings us neatly to our third key takeaway, the liquidity lifeline. Why secondary funds became the unexpected heroes of a tight market.
They certainly did step up. Secondary funds offered crucial liquidity, really, at a time when those traditional exit avenues like IPOs, initial public offerings, and M&A, mergers and acquisitions activity were significantly down.
Okay.
And remember, those limited partners we just talked about, the investors, they were demanding returns and looking for ways to rebalance their portfolios.
Yep.
Secondary funds provided a vital pathway to achieve just that.
What's truly fascinating here is just how significant this shift has been. Are we talking about just a minor uptick, or is this a major reorientation of capital flow towards secondaries?
Oh, it's a major reorientation, particularly when you look at the scale. Median secondary fund sizes, they practically exploded. They nearly tripled in 2024 alone.
Tripled.
Yes, jumping from around $164 million to almost $600 million. That's an astonishing leap.
That is huge.
And if you look regionally, say, in Europe, the Middle East, and Africa, secondary fundraising share of regional capital commitments has just risen steadily since 2022. Year to date, it constitutes an impressive 39%.
39% of all capital in that region.
Correct. That's up dramatically from just 7.9% in 2024. And this isn't just a regional anomaly. We're seeing this globally.
Wow, that's a massive jump. And as you said, it's global. It clearly points to a broader lack of liquidity in the private capital ecosystem right now. It's almost as if secondary funds are providing a much-needed pressure release valve for the entire market.
Precisely. It's a market response to these challenging conditions. Which leads us quite naturally to our fourth key takeaway. And this one is significant, the dry powder paradox. Why trillions are sitting idle and getting older.
Right. So what does all this turbulence mean for dry powder? Just to remind our listeners, that's the capital private fund managers have raised but haven't yet deployed into investments. Historically, it's been seen as a sign of future investment activity. But what's happening with it now?
Well, the headline is global private fund managers are indeed holding more deployable capital than ever before. It's a huge amount.
More than ever.
Yes. To put it into perspective, cash on hand, which is basically the ratio of end-of-year dry powder divided by the contributions during that year, it grew to a record 5.5 years by mid-2024.
5.5 years.
Yeah. That means, on average, fund managers have enough undeployed capital sitting there to last them over 5 years at their current deployment rate. It's truly an unprecedented amount sitting on the sidelines.
And it's not just that there's a lot of dry powder. The report really highlights that it's aging dry powder. It's money that's been waiting around for quite some time.
That's a crucial point. The share of dry powder that's older than 3 years grew to 57.1% in 2024. That's up from 49.2% in 2023.
Wow, over half is older than 3 years.
Exactly. And this trend, this aging dry powder, it has historically correlated pretty closely with economic downturns. For instance, if you look back to 2010 after the global financial crisis, 66% of dry powder was older than 3 years. So we're seeing a very similar pattern emerge now, indicating the sustained slowdown in deployment.
The implication here seems pretty clear then. This points to a significantly slower pace of investment, despite the fact that total global assets under management, or AUM, actually rose slightly, didn't it? From $15.2 trillion to $15.5 trillion in 2024.
Correct. A huge pool of assets, but a substantial portion of the contributions making up that pool has simply not yet been deployed.
So what are managers doing?
Well, what we're fundamentally seeing is fund managers adopting a far more cautious, strategic investment approach. They seem to be prioritizing sustainable growth and applying much greater selectivity to their investment decisions rather than maybe rushing to deploy capital into what's clearly a turbulent market. They're waiting for the right moment, the right valuation, perhaps.
Okay, that makes sense. Waiting for the storm to pass, maybe?
Yeah.
So, given all these challenges, the downturn, the shift to experienced managers, this mountain of aging dry powder, how are fund managers adapting? This brings us perfectly to our fifth and final key takeaway: tech to the rescue. How innovation is navigating private capital's stormy waters.
Right. To navigate this ongoing economic uncertainty, and importantly, to prepare for when that dry powder finally does deploy, fund managers are increasingly leveraging technology. And this isn't just about, minor efficiency gains anymore.
No.
No, it's about fundamentally streamlining processes, enhancing transparency, which is key for investors, and ultimately accelerating deployment when those opportune moments finally arise.
Okay, so what specifically does this look like in practice for them? How are they actually using technology day to day to manage these massive shifts?
Well, we're seeing digital platforms and quite advanced data analytics being used to significantly improve due diligence processes. And this isn't just about faster analysis, it's about getting deeper insights and, crucially, fostering greater trust with those limited partners we keep mentioning.
Right. Transparency builds trust.
Exactly. And beyond that, automated reporting is playing a really crucial role. It helps reduce those administrative burdens, freeing up managers to focus on strategic decisions rather than getting bogged down in manual, time-consuming tasks. You can imagine the time saved there.
Absolutely. So as this dry powder continues to age and the market waits, maybe nervously, for that inevitable deployment surge, technology isn't just an advantage anymore. It sounds like it's going to be absolutely critical.
It's really no longer a nice to have. It's rapidly becoming an absolute necessity. Technology is essential for effectively managing these vast amounts of data, for strengthening those vital relationships with limited partners, and, maybe most importantly, for staying agile and responsive in what is clearly a rapidly shifting and uncertain market. The future of private capital, well, it will undoubtedly be tech-enabled.
So to kind of synthesize the core message from this really insightful SS&C Interlinks report, we're looking at a market in profound transition. It's characterized by, well, caution, significant consolidation among experienced firms, and a strategic pivot, especially towards secondary markets, and critically, as you just said, a deep reliance on technology.
Yeah, that sums it up well, and perhaps this raises an important question for you, the listener, to consider. As the market continues to reset, how will this increasing reliance on technology further redefine the very definition of experience for fund managers? Does tech level the playing field? And what new opportunities might that create for emerging firms down the line, even in a consolidated market?
That is a really thought-provoking idea to leave everyone with. For more insights and the full analysis from the report, you can download the complete report now. Just click the link in the show notes.